A better run of good news on our local data has seen the pressure come off the Reserve Bank to reduce official interest rates. Although we still expect the second half of the year to challenge the RBA with monetary policy as global growth slows. But the resilience of the Australian economy is back in focus, with the latest jobs data a good example. The official unemployment rate fell to 5.7%, a 2.5-year low. But more importantly, you can see both full-time and part-time jobs growth is running at over 10,000 net increase, looking at the 6-month average. A rise in the jobless rate is the most likely precursor to the much-discussed risk of a housing bubble, so no sign at all of this at present. Equally important for the strength of our domestic economy is business confidence, and as you can see from this chart, the latest NAB survey results are pleasing. It shows a sharp increase in both business conditions and confidence, despite the recent barrage of troubling news from overseas and potential distractions around next month's federal budget and a possible double dissolution election. The pickup in business confidence was broadly based, and while the services sector remains the strongest and the area with the greatest level of jobs growth, the only soft spots were unsurprisingly in mining, in regions away from the eastern seaboard, and some of the retail components were slightly disappointing. The retail read matched a fall in consumer confidence in the latest Roy Morgan poll, and a deceleration in retail sales growth. However, overall, the combination of low interest rates, low petrol prices, and a low exchange rate has been good news for business. Even the data from China was better than expected, with a rise in Chinese exports and import volumes, although some of this data has seasonal complications. But more significantly for Australia, the related rebound in iron ore, the price of oil, copper, and some other commodity prices is on balance welcome news, especially after the International Monetary Fund this week downgraded global growth from 3.3% to 3.1%. How much comfort can we take from these recent good news stories? For Australia, it's all about the transition of our economy post the mining boom, as our terms of trade falls back to earth after a once-in-a-century spike. So how we can avoid a collapse in our standards of living and budget revenues after the resources boom, which will be dependent on the services sector and service exports such as tourism and education. This is where the level of the Aussie dollar becomes so important. We still expect the Aussie to be well supported in the months ahead rather than falling back into the 60s due to weakness emerging in the United States. But on a trade-weighted basis, the TWI hasn't rebounded as dramatically as the Aussie dollar, which is probably one of the factors explaining the resilience of our economy, the broad dimensions of our trading partners, and our sources of demand. The global economy is not out of the woods, but our domestic outlook is displaying its typical grit and stubborn determination. Until next week, that's the market update from Bendigo Bank.